Good evening, Jacques here from Mortgage Allies. Right, so I am going to talk to you tonight on lender philosophy. It's not like, gosh, Jacques, we didn't come here for a psychology lesson. You're right, you didn't come for a psychology lesson, and I'm not gonna make it one. I'm going to share with you some things that you should know about. Get to know yourself better. If you want to get to know somebody in life, you kind of want to know about their philosophy. It'll tell you a lot with them. It'll tell you also, you can probably predict who they'll be and what they will do based on their philosophy, right? And so that's what we're going to be focusing on tonight. And this is part 3 in our life cycle costs series. Basically, the life cycle cost series, I'll explain to you a little bit later on, is if we go through the entire series, you should be able to know quite a bit about a mortgage. You really, without having to go into the kind of nitpicking of it, but you should know quite a bit if we go through all of that. All right, so we are going to talk tonight essentially about a few things. The power imbalance in mortgages, there is a significant power imbalance, and you'll see that in a second. The conflicts of interest that you see, that you'll come across in mortgages, and how mortgages, remember we're talking about the lender's philosophy, right? If we look at mortgage products and you see the kind of trend they follow through, that should give you a few, okay, I'm going to look out for some more stuff, okay? Complexity, really? Does it really have to be so complex, mortgages, right? You need like a PhD in psychoanalysis to be able to get a mortgage. Like, it doesn't make any sense, right? And we're going to kind of scratch the surface a little bit on conditioning. In other words, what if we accept it to be true without questioning it? Okay, and so we're going to kind of dig into there a bit. And then at the end, I'm going to say what you can do to make sure that you are, you protect yourself, and you kind of, I kind of say you think for yourself, because in our system today, we are kind of, if COVID has done one thing for us, it's kind of disrupted us in the sense that, I say it with respect for people who may have lost their lives or their businesses or their livelihood. I say it with deep respect for that. But what it has made us stop, if you can remember those first 3 or 4 months in COVID, I remember walking on my street, and I was walking, and I didn't even have to look behind me. There were no cars coming. Everything was dead quiet, right? And so people are like, hey, I need 2 cars still? Or, oh, do I still need this? Really? Why have I bought myself 6 suits? I don't need 6 suits. And we were kind of questioning paradigms, right, that we believed that was the only way to do things. And I'm hoping we can do the same thing when we look at mortgages, okay? So to be clear, I am not a lawyer. I'm not trying to give you legal advice. I am not bashing the financial industry. I don't have an axe to grind. I work in the financial industry. My livelihood comes from the financial industry. But so the question is then, why do I do this? Okay. I truly believe, and I'm kind of up to here, that people don't know. Like, I believe everybody deserves to know what they're getting into, And when I look at products that come across my desk from, certainly not, I would not have placed those products. I would go like, man, this is just a piece of garbage product. This is not good for the client at all, And so we truly believe that you want to do what's best for you. The more information you have, and if you apply that information, you truly can do what's best for you. You don't have to just, accept an interest rate over an email. You don't. That's not mortgage education. Okay. All right. So let's look at Mark Twain, and B.F. Skinner has written a lot about behavioral science, okay? And it says past behavior is the best predictor of future behavior. Okay, so if you want to see, in the sense of the mortgage industry, what a lender was going to do in the future, well, just look behind. Let's look at some of the stuff that's been done, or or what is being done right now. You'll probably understand where they're going to go with the next product. Okay, so important to kind of look at the behavior. They say once you know what your values are, your decisions are easy, okay? And so the same thing, once you know what a lender's kind of trend is, then you know what you should be careful of there as well, okay? Again, so how does this apply to mortgages? Once we understand why financial institutions exist, their products, and why they offer those products, it'll help us to better predict what we can expect from them, okay? In other words, once we know the source, we can determine our level of trust. And I kind of give this advice to many of my team members, and I live by this advice. It says, I'm an avid reader. So I don't scroll on the internet to find whatever I can read. I find authors and I research their values, their beliefs, and their experience. In other words, with all due respect to 14-year-olds, any 14-year-old or 15-year-olds or 28-year-old can sit in a basement and give you advice, but you kind of like, gosh, have you done some of the things you're advising me about? And so I'm looking at authors. I want to make sure I trust an author, their values, their beliefs, and experience. Once I know that, I know I can trust their works because their work flows from who they are as people, okay? And it's the same thing with mortgage lenders. No difference whatsoever, okay? So let's talk a little bit, starting to talk about power imbalances. What I mean with that? Are all things equal between you and I as borrower and the financial institution offering a mortgage? Okay, so watch this. This comes, by the way, comes from an article. Here the references from Westlaw Journal of Legal Studies, volume 5, issue 4, blah, blah, blah. You can have a look at there, okay? So basically, the question is, we colloquially refer to mortgage penalties. Okay, in other words, if you break your mortgage, you pay a penalties. We call them, the common name from is penalties. But guess what? Here's a clue for you. Guess what? Lenders refer to them as prepayment charges. Why is that? Look at this. Because if they call it a penalty, penalty clauses are generally not enforceable by law, right? So if they call it a penalty, I'm going to charge you a penalty, you're like, you can't really enforce that. So they call it a prepayment charge. So right there, see the semantics? Clue number 1, okay? Look at the next thing here. In the 2010 federal government budget, there was a promise in that budget that the government will address the inequality in mortgage penalties, okay? Guess what happened? Crickets. Zip. Nothing meaningful. Why is that? So you will see if you go through the laws, some of the laws that are still applying today have been in effect since 1910. So 22 years, some of these laws have been around. Do you think mortgages have changed a little bit? Oh, yes, they have. Okay, so what I'm saying to you is, why is that? We should ask the question why that is, okay? And again, there's no boogeyman here. I'm not a conspiracy theorist, but it tells a story, right? If legislators decide that smoking is not good for us, they'll make a decision just like that. No smoking in cars, can't smoke around a toddler, you can't blah, 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 all that kind of stuff. I'm not a smoker, so I'm not picking a bone about that. I'm just saying, if they want to change it, if it's not good for us, they can do that. So why is it they haven't changed this, okay? So here's the crazy part. Mortgage penalties are essentially unregulated and problematic for consumers, particularly because the mortgage market is relatively concentrated and oligopolistic. Okay, so let's talk about that. What is an oligopoly? An oligopoly is when there are very few players in a space and they kind of collaborate with each other, okay? And concentrated meaning in our mortgage market right now, there are many small players, but they're essentially what we call the big 5, okay? So in other words, it's an oligopoly because those guys essentially, you've never seen one bank discount a rate by 1%. Why? Look here. Because in a concentrated market, companies compete by image and advertising. Oh, come to us, we're great and stuff like that. But avoid genuine competition on real issues. Why? Because they understand if they do compete with each other, it truly is a race to the bottom and reduces their profit. If that doesn't go, what? Okay. Rockefeller, if you read the history of Rockefeller was Standard Oil, right? He had a power and they broke him up into many companies. Now, and that was a monopoly, not an oligopoly. I understand that. But the point is, governments deal with that stuff pretty quick. Why is this not being dealt with? Okay. And so it's very concentrated because essentially mortgages come from the big 5. So you can see the power imbalance here. Look at this here. This is what we're talking about, right? Is there a power imbalance? Oh, you'll see the law clearly states that, okay? Listen to this. Lenders whose primary motivation is to earn profit, in effect, set the terms for mortgages. Okay, hold on. So what you're saying is lenders are there to make profit. No surprises. Guess what? You and I are there in life to make profit. That's how we pay for our retirement. That's how we trying to get a good life, okay? The thing is, though, is they set the terms for mortgages, And here's the key. While there are many players that sit in Canada, it's essentially the big five that set it all. Section 10 of the Interest Act does not protect Canadian borrowers from the unregulated and highly concentrated market. So in other words, you and I, there's nothing in the law that goes right now that goes to the bank and say, listen, stop it. You guys are not competing with each other. You need to start competing. And I'm going to show you some evidence of that in a second, okay? That should be cautioning us. We should be careful of that, okay? Another act, the Land Registration Act, delineates the filling of standard charge terms. So if a bank wants to have a mortgage, they must to file standard charge term, which is essentially what we call the mortgage contract. I know this is a little bit dry. Hopefully you're not falling asleep on me here, okay? I can sing, but then you'll definitely fall asleep. So I'm not going to do that, all right? So look at this. The law does not impose any conditions. So in other words, the banks can actually put any conditions in their contracts, any of them, okay? And in other words, what it means is the lending relationship between the banks and borrowers is highly unequal. If you have two, let's just say you've got Bank X competing against Y, that is fair because they both have the same resources to compete and to do what they need to do. But when you've got a massive organization that's part of an oligopoly and a saturated market, and you've got an individual borrower, gosh, what chance do you and I have against those kind of resources? Pretty much zippo. And so there's no law that protects the consumer from that, okay? And this is another very big reality. Many parts of mortgage contracts depend on the lender's discretion, which is concerning and not equitable. In other words, it says your mortgage is portable. Okay, let's just say that your mortgage contract is portable, but it also say there, subject to terms and conditions and qualification. Well, who decides that you qualify? There's no law that says for your mortgage to be portable, all you have to do is meet these 5 criteria, you can port your mortgage. No, it's left to the lender's discretion. Well, I don't know about you, lender's discretion means if they wake up on the wrong side of the bed one day and they don't want to give you a mortgage, they can do that. It's completely legal for them to do that. In other words, it's unequal. It's not equitable at all. It's more, all of it's resting in the favor of the financial institution, which is not a good thing at all, okay? Now, here's another thing that is quite interesting. Class action lawsuits, okay, are very expensive for the plaintiff law firms to manage over time. And so it's almost impossible to win those against deep pocket adversaries such as the bank. Well, I always say, I'm a mortgage broker. I have a lawyer. But there's no ways I could compete with any of the big banks. They got lawyers, lots. So they have very deep pockets. They can play this game all day long. And look at this. This is 2015. In 2015, there were literally hundreds of class action lawsuits. But look at this. Only 17 have led to actual trial. Okay? So, and here's the other part is they actually normally get settled out of court. Why? Because if they make it to court, they may affect legislation. So in other words, it's a bit like why did it take this long for the electrical car to become popular, okay, or viable? Because when patents were coming out, the gas companies were buying out those patents to protect themselves, right? And so when one of these lawsuits make it to trial, to court, well, some people are probably going to take note, and it probably may end up in legislation, which is not good for the bottom line. Okay, so it's important. So you see where I'm going with this? There's definitely a power imbalance in the process, okay? And you'll see that a little bit later on as well. Okay, so that deals with that for now. Let's talk about conflicts of interest. Now, there are some straightforward conflicts of interest, and you'll see why I said in a second. Okay, so lenders exist to make profit. There's nothing groundbreaking that I just said. As I said, we all do that, okay? And a large share of their profits come from loans. In other words, I don't believe in a scarcity mindset. A scarcity mindset says for you to have more, I must have less. I don't believe in that. I believe, there are infinite ways that we can all win. I understand it. So one of the ways that we win is to buy a house in Canada. You need a loan typically. Good luck trying to buy a house cash for the average person in Canada. Probably not going to happen, okay? So mortgage loans have their significant benefit for us, okay? However, not all mortgage loans are equal, and many loans have been designed to benefit the lender more than the borrower. So if you look at loans, you'll see they've been created to essentially force, quote unquote, air quotes, borrowers to be loyal to a bank, because the longer you stay in a mortgage, the more profit you make. So in other words, we'll ask a few questions in a second, okay? I say this all the time. It's like my favorite joke. It's like a dad joke, but it's so true. There is essentially very little to no love in banking. When a bank gives you a product, you should never feel like, oh, I feel so special, okay? No, I'm sorry, it's not because you're special, okay? It is because there is significant profit for a lender in that product, okay? If they push a product, or if a product is on special, and if argument's sake is a few good examples. If 5-year fixed rates are low, and a lender gives you a 4-year or 3-year fixed rate with a slightly reduced rate, why are they doing that? Well, one of the reasons could be that because they know in after 3 years, their rates would have gone up and they would make their profit back in the last 2 years. Okay, that's one thing. Right now, we in the industry are being incentivized like crazy to sell you variable rates. Okay, I mean, why? Because variable rates are extremely low. Why are they low? Because if you look at all the reports, all of the economists are saying that rates will go up probably 8 times by the end of 2023. Okay, so that means as rates go up, the banks will make their profit at the back end. So it's not like, you know what, it's Tom Canadians get a break. Let's give them lower variable rates. Not at all. It's because banks know that rates will go up and they'll make their profit later on in the process, okay? And you just have to look at banks' profitability. Look, I got to tell you, I am very happy that we have a very profitable banking system, because we escaped the 2007 crash and we are very liquid as banks. It's great, okay? But my gosh, you know, some of these banks are making $1 billion, one with a B, profit per month, okay? So during 2020 and 2021, during COVID, banks were making significantly increased profits, okay? So that's not because they huggers, okay? That's because they are absolutely profit machines. So I always say this, be careful of the advice from someone who profits from their own advice. Oh, take this product, it's really good for you, okay? The next question out of your mouth should be, and how are you benefiting from that, okay? So 2 questions you should always ask to determine conflict of interest. Whose interest is the lender serving? Its shareholders or the borrower? Who is the bank fundamentally accountable to? It's shareholders. Nothing spectacular about that, okay? So it will get profit, okay? Not the borrower, okay? Look at this here. And as I said, if a financial institution pushes a product or gives specials on or incentivizes its sales force, why? Because it's going to make a lot of profit from that product. So if you go to a financial institution, you're looking for a product, and the very first product that comes out of the person's mouth, you should question, okay? You should very much question that, okay? Cool? Good so far? All right. If you look here, the next thing we talk is products. How should you check out products? Remember, we're trying to see the philosophy of a lender. By looking at what it does, you understand its philosophy. If you understand its philosophy, you know what they're probably going to offer you. Okay, so mortgage products, important to know, a mortgage is not a mortgage, okay? Most people think, oh, you just give me the interest rate and good to go. It's not the truth at all, okay? So be very, very careful. I always say, you know, if I look at my own mortgage, it's never the lowest interest rate. Almost never the lowest interest rate, because I understand the garbage that comes with that stuff, okay? So mortgage lenders and their products can have very costly difference. I don't know if you knew this, but most lenders have one set of products that are fairly healthy. Then they have another set of products which are slightly discounted in interest rate, like 0.05. Those are the people who are just looking for an interest rate. But the terms and conditions here are bad, okay? And nobody asks about those terms and conditions, so they give them a cute name, a rate plus or a flex or like it sounds like it's wow, it's amazing. It's not, it's the other side of wow, okay? So be careful about that, okay? As a general rule, you should be careful of complex mortgage products because they have been designed to force borrower loyalty. The safest product you can get is a cookie cutter mortgage. Okay, but be careful. It's very hard to identify those cookie cutter products because they can look like cookie cutter, but they can have a whole bunch of nonsense in them, and you should be very careful of those. So here are a few things that you should be cautious of, that you should always ask. A collateral charge on a mortgage. Okay, why should a property be collateralized beyond its approved loan limit? What does that mean? So let's just say you buy a property for $600,000. Good luck with that, but we'll use this as an example, okay? Your mortgage is $600,000, sorry, the house is $600K, and you have a mortgage of $400,000, okay? So what should the collateral charge be? It should be $400,000 because that's what your mortgage is. Well, some banks will go 125% of that property's value, and they spin it like, oh, this is fantastic for you because if the house increases in value, you have access to that equity. Well, first of all, that's a bunch of baloney. Second of all, you have to still qualify for that. And second of all, why would you tie your entire house up? Who benefits from it? Not you, the financial institution. It does that, okay? There's always a story behind the story. Fully closed mortgages. This is nasty stuff. Again, all of these typically come with a slightly reduced interest rate, okay? Slightly. I'm talking microns, okay? So fully closed means you cannot get out of that mortgage unless you sell the house. Okay, so good example. Clients of mine have a house and they wanted, this last spring, they wanted to put in a pool. I didn't place the original mortgage, but they asked us, Jacques, can you take some equity out? We want to put a pool in the backyard for our kids. And we do that. Mortgage goes all the way to the lawyer. Sorry, can't continue. Why is that? The mortgage is fully closed. In other words, you cannot refinance that mortgage until you hit the maturity date, okay? And so be very, very careful of that. Home equity lines of credit, okay? What we call HELOCs, they have a legitimate purpose. If you have a very clear intent for that, you want to invest or you want to do this or you want to do specific with it, you could have a good case to have one, okay? But understand, lenders offer these products because they know borrowers will typically use them even if they think they're not going to use them, okay? It's easy credit. I've told the story probably to the point of boredom. I've done the math. If you took $100,000 line of credit, okay, you can walk into a Porsche dealership and buy yourself a Porsche. You know what that car is going to cost you? About $300 a month, okay? If you bought that same car from the Porsche dealership, the payments can be about $1,800 to $1,900 a month. So ask yourself the question, would you walk into a Porsche dealership and buy a car for $1,900 a month? You were like, are you crazy, Jacques? I'd never do that. But the illusion, $300 a month, I'm driving a Porsche, okay? Illusion is great. So I'm saying to you, they offer these things because they know human behavior, okay? So be careful of that, okay? You need to know the difference between contract and posted rates. Now, this sounds like Greek. Let me share the following with you. Okay, so I don't know if you knew this. Watch. Every lender, and I'm picking on the Greek bank, all of them are the same thing. I have no issue with TD, but all of them work exactly the same way. Watch. Let's look at a 5-year rate. See that? So TD says its 5-year rate is at 2.9, okay? And what is that thing? That 4.59 with a line through it. What is that thing? Okay, so we're like, okay, I don't quite know what that is all about, but let's pretend we don't know. So then here, let's take another lender. Here's Merrick's Financial, okay? Merrick's Financial says we're going to take for exactly the same mortgage, okay? See here, we're saying a 5-year special rate closed, okay? We're looking at Merrick's actual rate. So here's Merrick's rate sheet, okay? And you can see here, it's 5-year fixed rate. The actual special is 2.59. That's the actual rate, right? That's the actual rate that you're going to pay. But Merrick's is for that same mortgage, their posted rate, look here, is 2.89, okay? So they're very close, right? There's only 0.3% different. Look at TD's here, okay? They have this 4.59, but the actual rate here is 2.94. Why would somebody do that? Why would they? Who's ever going to walk into a bank and say, oh, I love the 4.59, please? Well, here is where the devil is in the detail. If you understand, the bigger the gap between, so in this example, and it's not specifically, but TD says 2.89 is the actual rate, but the actual posted rate is 4.59. Here's what the bank does. It says, it gives you 2.89, okay? And you go like, whoo, I won the race. Well, what they do is they take the difference between the two and they then say, this is the discount they give you. The bigger the discount, okay, that discount gets applied when you break your mortgage. They'll say, we gave you a discount of X. Now we want to get the profit we've lost because the discount we gave you back from you. You see? Now you look at Merix, there's 0.3 difference. So it's very straightforward that Merix's penalties will 99.9% sure be less than TD's, and TD's will be exaggerated. And again, not picking on TD, pretty much all of the banks work the same way. Okay, that's important for you to know. Okay, number one. Okay, number two, remember you're looking at ways to determine how your lender will treat you. So if you want to know about your penalties, right there. Okay, the other thing is if their posted rates are high at the end of your 5-year term, what interest rates can you expect to get from your financial institution? Well, if you're already a client, right? And after 5 years, it's such a pain. I don't know if you knew the stat, but 85% of people will just sign the renewal agreement because they're like, I don't want to go through those documents again. I'm so done with that. Like, I'll just sign the forms. Well, guess what happens? At renewal, the banks will lean towards their posted rates, okay? And so if you look at a bank, you're probably going to be closer to this because you're already a client, where if you look at Merix, their retention rates are in the 90%. They come out hard with really good rates. And I'm not, advocating just for Merix. There are many lenders just like them. But it's important, once you understand the difference between the posted and the actual contract rates, it'll tell you really well how they will treat you in the future, okay? Magical interest rates, okay? Poor or unsuitable mortgage products are often disguised by reduced interest rates. Do not be blinded by interest rates. Do not be blinded by interest rates. I use this example. If you take a Rolls Royce, it's probably the ugliest Rolls Royce you've just seen that I've drawn here, okay? You put a Rolls Royce there and you put a little toddler right there sitting here with there's like a gazillion dollar Rolls Royce sitting here, okay? And you take a dollar store rattler and you give it to the toddler. They will ignore that Rolls Royce so fast, it is not even funny. They'd like the thing that makes the most noise, that's going to be their best friend, okay? So in other words, this great, incredible car is ignored for the thing that makes the noise. And that is what interest rates are. They are literally a distraction, okay? I didn't say you should just ignore them. Take the highest interest rate. Not at all. I'm saying to you, see it for what it is. Look at it. It's a distraction. Dig deeper. There's typically stuff that you should know about, okay, before you just accept that, okay? And watch out for over-focus on interest rates. Many mortgage salespeople over-focus on interest rates to secure the sale, okay? I've seen this. I've seen clients go to financial institutions and brokers, to be fair, and like, oh, they offered me X. And I go, okay, is that product suitable to you? Yeah, but it's a low rate. And I go, but is it suitable to you? Is that what you want? Is that what it's going to do for you? What about if you do this? And you're like, oh gosh, okay? So do not allow any salesperson to over-focus on interest rate. Most people's mortgage education from an financial institution or broker is an email with an interest rate, okay? That is not education, okay? Next point, actually, good segue, is insist to be presented with option and educated about suggested mortgage products, okay? Don't just, accept a rate, okay? And then the next thing is, what happens after closing? Most of us, we are anxious to get the mortgage, right? So this is the closing date, okay? We're anxious to get into the house. That's it. I want that to happen. And if because of that, we neglect to ask what happens afterwards. What if I want to change my mortgage? What if I want to refinance? What if I want to sell and buy? We don't ask those questions. What happens at renewal? We don't, we don't know. We don't ask those questions. And that's where the terms and conditions bite us. So consider what happens after a mortgage. And it'll be quite revealing to you when you start asking those questions, okay? In fact, your salesperson will probably fall off their chair because they've never been asked that. They'll probably grasp for straws. So do ask those questions, okay? Cool? All right, complexity. Mortgage products and terms and conditions are more complex than they should be, okay? And if you look at the facts, which we'll do now, you kind of like, gosh, is kind of suspicious, makes you suspicious. Why are these things kept so complex? Because It don't have to be that way, okay? As I said here, a lender discretion, most mortgage terms and conditions favor the lender, and the application is often subject to lender discretion. So in other words, the application of those terms and conditions are at the lender's discretion, okay? It's a bit like at school, you're about to write exams, but the teacher is allowed to mark you wrong or right, depending on how they feel on the day. Like, gosh, what am I supposed to do past this course? It becomes really crazy, okay? Now, watch this. Your mortgage contract actually constitutes a few parts. You've got the actual mortgage commitment. Inside the commitment, it calls out what we call standard charge terms, okay? Those standard charge terms, guess when you get those? You're getting those from the lawyer 2 days before you close the mortgage. Okay, so what does that mean? It means that if you don't like that, it's 2 days before you close. Well, guess what? There's not much you can do about it, right? And so that's a problem for me. Like, why would those things not be like disclosed right up front, so everybody kind of gets to know what they do? But again, we're in a very concentrated market in oligopoly, right? So very important to understand that. Okay. Terms, conditions, legal advice. So now you go to your lawyer. I'm not blaming the lawyer. I'm just saying the lawyer says, here's a copy of your mortgage contract. Please sign that you received the copy. And you go, wait. Hey, lawyer, can we not go through that? Can you explain that to me, please? And the lawyer says, oh, no problem. $600 an hour. We can do this all day long. And you go, what? You do the math and you're like, oh, gosh, like 8 hours. Or how long is it going to take me to go through? It's going to cost me a fortune. And you go, nah, it's okay. Don't worry about it. So you signing, most people, that's why it's unequal. It's not fair and unequal. Most people sign the thing, they receive the copy, and they don't really know what they're getting into. And then the other thing is, are terms and conditions really negotiable? So I've been doing this for 16 years. I have never ever seen a client that have won a fight with a lender where the lender says, okay, sure, no problem, we'll change that terms and condition for you. They will not do that, because it's kind of like that's why most people just sign for the thing, because what are you supposed to be doing, right? There's not much you can do about it, okay? All right, so penalty interest rates. As I said, most lenders have a contract interest rate and a separate posted rate. Why would you have two rate systems? Like it's like smoke and mirrors, right? So why would you do that? So why is it so complex? Why can't it just be so straightforward? And here's something that you don't know. For me, this always annoys me. I'm in the industry. I'm a mechanical engineer. I can do math. I can really do math. Okay. The point is that nobody can calculate your penalties except for your lender. I can estimate them. And if a lender gives you a penalty, that penalty is only valid for that one day. Okay. If you go to your lawyer and say, look, lawyer, can you just verify that the bank is kind of calculating my penalties right? The lawyer's going to look, I can't do that. Nobody can. Okay. And so that's not a good thing. Like, you don't want to have the fox watch the hen house, right? That's not a good thing at all, okay? And mortgage reporting, listen to this. This is quite, for me, has always been revealing. Mortgage lenders, look at this, have agreed amongst themselves not to disclose their lender name on credit reports to avoid cannibalization of each other's mortgages. So in other words, watch here. Here's a real example. I've obviously covered all the things up important. I've checked it. This is my company. I checked it. It's not like I know the details here. So watch. At the top here, see, that's a mortgage. See that? That's a mortgage there. You can see it. Now watch. Where's the lender's name? It says BB. All of them say BB. Now if I go down here, look, it tells you this is a TD loan, and I1 there's another TD loan, and there's a CIBC card. It tells you all the details who it's from. But the mortgage, no mortgage lender here. So literally, I've heard this from Equifax directly, is banks have agreed to not put their names on the credit report so that they don't cannibalize each other's mortgages. Now, if you've ever talked about an oligopoly and a concentrated marketplace, right there. Okay, so the rest, you can take, no problem. But mortgages, don't touch my mortgages. Like, who can do that, right? That's just not anywhere else in the industry that would not be allowed. Okay, so there are complexities that don't have to be there, and we should be careful of things like that. Okay, by the way, I don't know if you knew this, but some lenders don't even report to the credit bureau, which is actually in your favor, okay? Because your mortgage actually cannot wreck your credit, okay? It's these things that can wreck your credit. So long story short there, but important to understand the complexity. Are mortgage penalties fair? Listen to this, okay? Borrowers incur a mortgage penalty if you have a closed mortgage or partially open mortgage if you break the mortgage. In other words, irrespective of interest rates. Okay, what have I just said? So in other words, if your mortgage rate is, let's just say 2.5, if you want to get a lower rate, okay, let's just say rates are now 2%, you're going to pay a penalty because you're dropping your interest rate. But if your rate's 2.5% and the rates are currently 3%, you also pay a penalty if you want to get a higher interest rate. Well, is that fair? Let's see. So if a borrower wants to reduce its interest rates, when interest rates fall, prepayment charges may be justified under a general principle of contract law because damages in breach of contract should fully compensate the loss of expected interest rates. So in other words, the lender thought it was going to get 2.5% worth of interest. Now rates at 2%, so the lender is losing that interest, and it's kind of justified. Now look at this. What if your rate is 2.5%, okay, and now current rates are 3%, okay? Well, guess what? You're still going to pay a penalty, but is that fair? Because the bank is quite happy. It's in their benefit that you break this mortgage because now the current rates are 3%. They can lend their money at 3%. They make it even more profit. Should you be paying a penalty to help a bank make more profit from lending the same money they lend out to you at a higher interest rate? That's not fair, okay? That's not fair at all. And this has been challenged many, many times over and has never been won, but it's not fair, okay? So that's the kind of thing I'm talking about. So penalties are not necessarily fair, okay? So the unnecessary complexity. Why is it that everyday consumer products such as a mortgage is so complex? It doesn't have to be that way, okay? It really does not have to be that way, okay? Why can mortgage penalties not be standardized? In the United States, as far as I know, all mortgage penalties are 3 months interest. You can sit around your kitchen table, pull out a napkin, take 3 months interest, and you know exactly what you're going to pay. Here, as I said, your lawyer can't calculate it. I can't calculate it. I can estimate it, but it's not, there's no authority behind it. The only one can is the bank, okay? Why can it not be standardized, okay? And why is legislation not being changed to address current unfair practices? Why? Okay, so in other words, why am I saying to you is I'm not just trying to stir up a hornet's nest, okay? There's somebody once said, don't make a fuss, make a difference. Okay, so why am I making a fuss about it? So that you can keep them eyes wide open. There are unfair practices that you should be careful of and not just like surrender your sort of your own conscience when you walk into a bank, okay? Or any financial institution or a broker or anybody for that matter, or a car loan. Always make sure, okay? So what? Here are some ways that we have unknowingly been conditioned. Okay, so watch this. So I'm a mortgage broker, okay? And if I offer you a mortgage rate, the same as what every lender offers, you're like, oh yeah, that's good, Jock. Thanks very much. But if I came to you today and say to you, and I would never do that, just be clear about that, okay? I have never done, never will do it. Okay, so if I come to you and say, hey, I've got a great second mortgage for you for 19%, you'd be like, Jacques, are you familiar? That's like predatory lending. That's like, that's like the worst of the worst, man. Gosh, what kind of thing is that? Why would you do that, Jacques? I would agree with you, actually. But look at this. Most of us walk around with a 19% credit card in our pocket, including me, okay, in my pocket, and we never question it. We just sign on, okay? It's a credit card. 19% you pay for that credit card, okay? In fact, if you take a store credit card, guess what? 28%. So if I came to somebody with a second mortgage with 28%, we're like, oh my gosh, I'll probably make headlines for the wrong reasons, okay? And it's the same thing here. You gotta, if I offered you 19% second mortgage, it would, I don't blame you to go crazy. But we've accepted this as a norm. People get interest rates, for their lines of credit unsecured, and it's like prime plus 5. How did the bank get to that? And so we just accept it because we're used to it, right? Now, I'm really going to stir up a hornet's nest here. Let's talk about your credit report. And I teach credit. When my clients with me, I will go through their credit report with them and I'll tell them how they can optimize it. But remember the following, okay? To get a mortgage in Canada without, it's a challenge to get a mortgage in Canada without a proper credit presence, okay? So in other words, for you to get a mortgage, you must open debt, you must make debt, you don't necessarily have to carry a balance, but you must go to a financial institution and open products with them so you can start registering a credit. Really? Really? It's like saying if you want to drive on the roads of Ontario, you must buy a car from Toyota. Be like, no, I'm not doing that. Okay? Why do I have to do that? Well, look here. Okay? So who benefits from that? So in other words, it's like a sales funnel. So hey, you want to get a mortgage? You first got to get some other product from me before you can get the mortgage. Okay, so do you see the conflict of interest there? Significant conflict of interest, right? But we're so conditioned. Hey, build your credit, build your credit. In the United States, you don't actually have to do this. You can say, no, 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 no. I don't want to have credit. You need to manually underwrite my mortgage. And by the way, this is what we used to do in Canada not long ago. You used to go get on the subway and go downtown Toronto and meet with an underwriter there, the broker would, and literally would open a file. And the underwriter they would say, okay, tell me, where's this client working? And you got the pay stub. And it's literally manual papers. You underwrite the product, okay? But we don't do that anymore. The credit report is the almighty report, okay? But the conflict of interest is before you can get credit, you must first buy a product from one of these lenders who are going to benefit from the mortgage anyway. That's a problem. Okay, that really is a problem. So be careful when banks call you up to increase your credit limits, all that kind of stuff. It's, the problem with all this stuff, they have visibility. If I check your credit like I showed you here, guess what? If I check credits and I'm trying to give somebody a mortgage, guess what I see? All of this. I see all of this. Okay, so in other words, I'm like, let's say I want the mortgage, like, oh gosh, this is a big credit card. Why don't I try and replace the credit? I can do that. So how fair is that, right? It's not really fair, right? So be very careful about that. Conditioning. We have biases that we've accepted that we really should be questioning, okay? Okay, so what can you do after all my rant? Okay, what can you do, okay? Protect yourself through discernment, okay, and education. There's an author which I really like. He is like a mad guy, Dave Ramsey, okay? I would highly recommend you dial into his podcast. Now I understand there are some nuances. You can still buy a house in the United States for $150,000. Good luck with that. Maybe a tent in Saskatchewan next to the North Pole, you could buy it, for $150,000. But for the rest of the mere mortals in Ontario, no chance you're going to find a house for that much. Okay, so not even a piece of land probably. Okay, unless you go very north. So educate yourself, okay? However, the best advice I could probably give you is this, okay? Keep your mortgage products simple and suitable, okay? Don't let lenders add bells and whistles that you don't need. Stick with the basics, okay? And question and ask questions until they turn purple, okay? Make sure you take a clean product. Okay. Now, if you do want a line of credit, make sure you have a reason for it. I've done a podcast, a webinar on that before, so have a look at that. Next one is, so a lot of people play around with financial products. Okay. In other words, like, oh, I'll get this credit card and then I'm gonna like charge this credit card up to 100% because that's at like 0%. I'll take that money, I'm gonna pay that credit card. All due respect to say this to you. Don't try and beat or out clever the financial system, okay? It is powerful. You've got financial institutions that make $12 billion of profit a year, okay? That's with a B, okay? And they are the biggest mortgage providers in the world, not Canada, okay? It's a machine, okay? They have studied human behavior to the T. It's like I always say, the best way to avoid being attacked by a lion is stay out of the lion's den. Okay, I wouldn't walk into the lion's den and see how long I can get away without being bitten. Okay, I don't do that. It's like, okay, lions bite, I'm out. Okay, so in other words, engage the financial system only when you need to. Otherwise, stay away from it. Okay, clever debt products. Okay, I'm going to say something that you may not like. Those points credit cards, those are traps like you won't believe. Okay, banks know the amount you get, like, you pay $120 a year for those points. Okay, and if you actually add the points together, what you actually get from it, gosh, those are all magnets created by banks to basically get you to use your credit cards. Okay, so obviously I'm talking about you need to invest and all that kind of stuff. So be careful. I'm just saying to you is I personally treat the financial system with suspicion. I really do. It's not because I'm as a boogeyman out there. I understand this. I don't know enough of all the mechanisms in the background that can trap me. So I go in, I work with a financial planner that I trust, and I stay, and then I disengage the system completely. Okay. The next one is, my dear friends, this is not easy in today's world. Get out of debt and stay out of debt. And I've done that by actually, surrounding my Dave Ramsey's material and stuff like that. In a world we are in today, I always say try and be the lender, not the borrower. Okay. And I understand I sell mortgages. I am not oblivious to that. Okay. But I always say if you can buy a house without a mortgage, then that's fine. Please do that. If not, let us help you to get at least a healthy mortgage so you can own a house and not pay rent for the rest of your life. Okay. And if you have any suggestions that you have for us, how we can make this better, please do let us know. We'd be delighted to help you with that. You can reach out to us here also. This is my personal cell phone number. This is a dedicated text number. You can also there, and of course in our social, you can reach out to as well. In the meantime, thank you so much for your time. It's been a delight to have you. We're humbled that you would join us. Thank you so much.